Hello, I'm Bhoj Raj Pangeni. Today's lesson we are going to right issue and related problem. Right issue means the common stakeholders has one right that is called the primitive right that gives to the its existing shareholders to subscribe the new equity shareholder issued by company, that is called right issue. And the numerical problem associated with right issue will be discussed in this video. These are some formula. Formula number 1, number of new shares equal to the fund to be raised divided by PS. PS means subscription price. And another formula is number of rights required to buy one new share. Hashtag equal to number of old shares divided by numbers of new shares. Number 3, theoretical value of right when right is on. Consider the red color word, the value of right. It's a value of right, not the value of stock. Be sure about that. And when right is on, that is right is on. When right is going on. So VR equal to P0 minus PS upon hash plus 1. P0 means current selling price of stock minus subscription price upon hash plus 1. Now, 4 number point, X right stock price. X right stock price. That is the price of the stock. This is not the right price of the right. Value of right. This is the price of stock or theoretical price of stock at X right price. X right means when right is outgoing, when right is expired, after right, that is X right. It means PE equal to P0 minus VR. Now, fifth, theoretical value of right when stock goes X right. Look at the red color, value of right. This is also the value of right, but when the stock goes X right means after right offering, the value of stock, the value of right will be X right price. VR equal to PE minus PS. PE means the X right price of stock minus PS equal to the subscription price divided by hash, where P0 means current selling price of stock, PS means subscription price or issue price. Now, look at the numerical problem. There is the question. ABC company currently has 2000 shares outstanding. This is the number of shares, not rupees or no monetary value. This is the numerical value that can be counted as a number of shares. So 200,000 shares outstanding, that is the old number of shares. The management of company required rupees 2 million for new plant. So the company required 2 million for new plant. So the fund to be raised or required fund amount is 2 million rupees. It's a rupees. And the company's current selling price of stock is rupees 250 per share. That is P0, market price of the stock or current selling price of the stock, equal to 250 per share. However, the company offers the right shares to its existing shareholders at rupees 200 per share. The offering price, the issue price, or the subscription price. This is the synonym of PS. Subscription price, offer price, issue price, new share issued to the existing shareholder, that price, and the offer price and the subscription price, these are the same. So the PS equal to 200. Required number of new shares to be issued. B, number of rights required to buy one new share. C, theoretical value of right when right is in on. D, X right stock price. E. Theoretical value of right when stock goes X right at rupees 247.62. F. Miss Muna Gimre has rupees 6,000 and 1,000 shares of ABC company. 6,000 is the cash value rupees and the 1,000 shares of ABC company. Find the wealth position of Muna before right offering and after right offering. If she exercise all her rights, exercise 60% of her rights and sells remaining, sells her all her rights and neither exercise nor sell her rights. G. Number G. Mr. Deepak Dhakal has rupees 10,000 at the time of ABC's stock goes X right at rupees 250 per share. He feels that the price of stock will rise to rupees 280 by the time the right expires. Compute his rate of return if he buys ABC stock at rupees 250 or buys the right at the price computed in part C, assuming his price expectations are valid. This is the question. Be sure the A, B, C, D, E are very short question and the F and G are a little bit more long question. So we consider this F and G. F is the wealth position problem and G is the rate of return or decision whether to purchase the stock or whether to invest in stock or whether to invest in right. That is deal with the problem G, and the wealth position problem is dealt with problem F. Now first of all you have to write the given information as far as possible. Given number of old shares 200,000 shares, fund to be raised 2 million, current selling price of stock P0 equal to 250 per share, offering price or subscription price of stock P0 that is the offering price by the company to its existing shareholder rupees 200 per share. And number A, number of share to be issued. The number of share to be issued equal to the fund to be raised divided by PS. Have a look on the given information. Fund to be raised equal to 2 million and the PS subscription price equal to 200 per share. Now we can get the new number of share equal to the 10,000 shares. So number B, number of right required to buy one new shares. Hash track or hash equal to number of old shares divided by number of new shares. Number of new shares can be computed in, we already computed at part A. Now the number of old share equal to the 200,000 shares and number of new share equal to the 10,000 share. Now we can get a 20 right. It means that if any one existing shareholders has a 20 rights or 20 old shares, then this shareholder can get one new share as a right share. 20:1 is our swap ratio. Now number C, theoretical value of right when right is on. VR equal to what? VR equal to P0 minus PS hash track plus 1. That is P0 means 250 per share minus PS means 200 upon 20 plus 1. We can get 2.38 per right. This is the value of right, not the value of stock. So you have to write rupees per right, not rupees per share or rupees per stock, but you have to write rupees 2.38 per right because it is the value of right. Be careful about this unit. Now D number point, X right stock price PE equal to what? PE equal to P0 minus VR. P0 is 250 and VR is, we calculated 2.38 in part C. Now we can get rupees 247.62. per share. This is the stock price, so you have to write the rupees per share because it is the stock price. Now point E, theoretical value of right when stock goes X right at 247.62, VR equal to what? Now P equal to 247.62 per share, and the VR equal to what? VR equal to the PE minus PS upon hashtag. Put the value of PE minus PS and hashtag, we can get rupees 2.38 per right. Now it's time. Look at all the calculation that you have made in part A, B, C, D and E. These information are required to compute the problem, to solve the problem of G, F and G. So be sure. Now it's time to compute the problem of wealth position problem of Muna Ghimre. Before right offering, she has cash rupees 6,000 and 1,000 shares, and the price of share before right offering is 250 per share as a market price, and rupees 6,000 and 1,000 into 250 equal to 250,000, and 6,000 equal to 256,000 is her wealth position before right offering. And after right offering, what happened to the wealth position? Let's see. After right offering, always use market price as a PE, X right price, because it's a after right offering price. So I exercise her all right. Exercise means she exchange or she purchase the new equity shares or new common stock from company at a subscription price by her right. And if she has 20 right, then she can get one new share, and she has 1000 shares. By this, 1000 divided by 20 equal to 50 shares can be taken or can be purchased at rupees 200. So her old cash balance equal to 6,000 and less cash 50 into 200, because 50 share is 50 number of share are purchased from company at rupees 200 per share, because the 200 is our subscription price, offer price by the company. Now 10,000 is less because she has to pay. So, and the number of share will be rise because he has a 1000 share before, and after right offering she exercise her all right, that is she get a new 50 shares. Now she has 1050 shares into after right price is 247.619, that is 62 equal to 260,000. Now she has a total wealth as a 256,000. There is no loss before and after exercise or all right. Now, and the next point is she sell all her right. If she sell all her rights, then what happens to wealth position? Now rupees 6,000 is the old cash balance, and if she sell all her rights, that means 1000 rights at rupees value of right VR, that is 2.381 per right. 1000 right and 2.381 per right into means 2381 rupees. Get two, she gets 2381 rupees by selling the right, and she has 1000 old shares at the rate of 247.619. That is the X right price because it's after right price, after right happening. Now the total amount is the same 256,000, no change in wealth position till that problem. And the third one is, if she exercises 60% of her right and sells remaining. Now 60% means if she has 1000 common stock, old common stock, existing shareholder, now the 60% is equal to the 600 right. If she exercise 600 right, that is 600 divided by 20 has equal to 20, then she purchased 30 shares from company at the rate of 200, so she has to pay the cash balance 300 share into 200 per share, 30 shares into 200 per share, that is 6000 less. And if she sells remaining means 40% of right, 40% of right means 400 rights into at the rate of value of right, that is 2.381. now now she has 1000 old shares plus 30 shares is the new share right shares, total 1030 shares into 247.619, and the total amount is same 256,000. This is also same before and after. Now neither exercise nor sell her rights, neither exercise nor sell her rights. Cash balance is her old cash balance 6000, and the value of stock will be value of right, that is X right price 1000 shares into 247.619, and the total amount is 253.619. Neither she get extra cash nor she lose, but she lose the shares value because she neither exercise nor sell her rights, and the value and the total wealth will be decreased by how many amounts? By the amount of rights, 1000 into 2.318, that is 2381 is her loss amount. So now we have to calculate the rate of return, whether it is better to invest in stock or it is better to invest in right of same company. There is two options for the investors, whether to invest in the stock or invest in right. Let's see. Amount of investment rupees 10,000, and the purchase price of stock, that is 250 per share, because the market price of stock will be 250 per share, and the expected price in the future is 280 per share. Mr. Deepak Dhakal expected that the price of stock will rise to 280 per share. So the expected price will be 280 per share, and the purchase price, that is current selling price, is 250. And the rate of return, if his expected price, the expectation will be valid, will be true, it means that the price of stock will be rise to 280, then what is the rate of return? The rate of return equal to the EP minus PP upon PP, that is expected price minus purchase price divided by purchase price into 100%. Now 12% is the rate of return from the market. And now the second one is not to invest in the stock but invest in the right of that company. Now purchase price of right PP equal to 2.38 per right, value of right is 2.38 per right. Now if Mr. Deepak Dhakal purchase a right in rupees 2.38 per right, and the expected price of right at X right EP equal to EP of stock minus PS upon has expected price of stock, that is will be goes to the 280 per share divided by PS equal to 200 divided by has. It is the expected price of right X right price, expected X right price. We get rupees 2 rupees 4 per right. It means that after right goes off, or after right offering or X right expected price will be rupees 4 per right, because his price expectation will be varied. Now the rate of return equal to the EP of right minus PP of right divided by PP of right. In the before part I, that is the EP of stock minus PP of stock divided by PP of stock. Here EP of right minus PP of right divided by PP of right. As a before, the rate of return is by the stock, and in this time the rate of return of right. Now 4 minus 2.38 divided by 2.38 into 100%, we got 68.07%. Wow, it's higher than stock. Invest in stock. Invest in stock and invest in the right of same company will yield different kind of rate of return. So be careful about that. Higher the return, higher will be the risk. So invest in the stock is less riskier than invest in the right, and the return of rate of return of right invest in right is higher, more higher than the invest in stock. Stock return is lesser than the right return. Have a look, 12% and 68.07%. How much? How many times? Now you are able to compute all the numerical problem regarding the right issue. Now you are requested to share, subscribe the channel for upcoming video. Thank you.